Life Management Science Labs would like to acknowledge that we live and produce this podcast on the traditional lands of the Wurundjeri people. We'd also like to acknowledge the traditional owners of the lands of our listeners and our international colleagues. We'd like to pay our respects to their elders past, present, and emerging. Hello everyone, and welcome to Wealth Pathways, the Affluence Science Insights Podcast produced by LMSL, the Life Management Science Labs. We are champions of life management science, providing structured insights informed by science and inspired by practice on key aspects of conscious living. Each week, we bring you scientific and practical insights on each element with the expert knowledge of professionals in the field. I'm your host, Marie Stella, coming to your ears from Naarm, Melbourne, Australia. Let's learn together. What does it really mean to invest in today's world? Is it riding the crypto wave or following the latest financial influencer? Or maybe there's something deeper that separates fleeting trends from lasting wealth. Hello and welcome back to Wealth Pathways, the Affluence Science Insights Podcast. In today's episode, we're looking into the core of modern investing and the difference that it can make between short-term gains and lifelong affluence. And joining us today is finance lecturer Gertjan Verdickt, who is currently based at the University of Auckland, where he explores the intersection of finance and history through research and teaching. So welcome to the show, Gertjan. How are you doing today?
Thank you for having me. I'm doing very well. How are you?
Fine, thank you. I'm really excited to dive right into this because I feel like there's so many misconceptions from a beginner's perspective about like what to do when it comes to investing. But before we do that, do tell us about your background and what compelled you to pursue finance, especially, the history surrounding it as well in your research and teaching.
So I'm originally from Belgium. I'm Belgian, was born 35 years ago and was born into a family that was very active in the financial markets industry. So my grandfather worked on the options side, so more derivatives in Belgium. My father was also in banking, but more on the IT side. So it's not really that I was spoon fed into finance and financial markets, but it was certainly something that interests my parents/grandparents. And when I had to make a choice before going to university, we had the great financial recession of 2007, and that actually was so interesting to me, like how a small bank actually can crumble the entire Belgian/world economy. And every day there were more stories and revelations about like how finance actually shapes not only the financial economy but also the real economy. And at that specific moment, I also had to make a choice, like which major I'm going to take. I took finance, never really looked back.
Yeah, that must have been an exciting time. Not exciting in like the most positive way, but just very eventful time to be interested in finance. Would you say that?
No, for sure. So it's indeed a very interesting experience, intellectually speaking. So indeed, like tragedy for so many people, also in Belgium, for sure. But intellectually speaking, super interesting time. And even like nowadays, we still reference the GFC in courses, in papers, in books. So it is a monumental time in our economic history.
Yeah, there've been movies made about it, which
For sure.
actually like from someone who like was never really that into finance, it's still like they're still really interesting to watch. But what would you say are some of the most common misconceptions that you've heard about investing in stocks, particularly?
So investing in stocks, particularly, there are many, but I think the one that comes back so often is skill versus luck. I think people in general overemphasize the level of skill they have in terms of stock selection and underappreciate the fact that luck plays a huge role in it. So what do I mean by that? It's not because you beat the market that you actually did a good job. Because I can beat the market every single day just by taking on significantly more risk. So whenever I come across a fund and fund performance, I always ask, sure, you have a very nice return, but what is the risk aspect? How much is your risk return ratio? Because if that is really good, okay, then we can talk. But if you only show me the return side, so for instance, you mentioned in the intro crypto is a very nice example. Crypto has amazing returns, but also a lot of risk. So that is something to me that you also have to take into account. And that is where this luck versus skill aspect actually comes in.
Yeah, well, thank you for sharing that. That was an excellent preface for our topic for today. But before we go further into detail, I would love to get to know you better. So this is Have You Met Gertjan? And my first question for you is, what is your favorite book?
Oof, I have many books I've read, and I always like switch between fiction and nonfiction. So I loved American Prometheus, so the story about J. Robert Oppenheimer. I thought it was fascinating. Also, after seeing the Oscar winning movie. But if you are focusing more on like nonfiction, on the other end, like When Genius Failed is a book I love, which is about LTCM, also an eventful financial moment in our history. Um, and The Hype Machine is something I just recently read as well.
So, what was it about these two books in particular that drew you in?
So it's mostly those very eventful moments in history, or moments that really shape history. So in the Oppenheimer case is pretty straightforward. Like, he created the atomic bomb, end of World War II, still see the aftermath nowadays in the current environment. But also on the LTCM case, it was in the early 1990s. Hedge funds, very important in the asset management industry, Nobel Prize winners. So even now in academia, they're still being talked about. So very eventful, very interesting in that respect.
Yeah, and what about movies? There are like counterparts to the books that you've shared. Do you lean that way as well when it comes to movies?
Yeah, so I watch a lot. So I watch sci-fi. So Dune, Lord of the Rings. Both read the books, both see the movies, stuff like that. Yeah, I
Yeah.
just saw the F1 movie, which I thought was amazing.
Oh, I haven't seen the F1
Yeah, you
movie. My
should.
my partner did though, and my partner's auntie, like they went together, and she was so revved up after that. I have no idea. Like I have no knowledge on cars whatsoever. Am I still able to watch that though?
Yes. Yeah.
Yeah, yeah. So what was the F1 movie about? Sorry, I don't have much knowledge on it.
So it's about like Formula One, basically a comeback story where the Brad Pitt character was a huge success in the beginning of his career, had an event, then came back out of retirement to mentor a younger F1 driver. So
Yeah.
it's not
Okay.
about Formula One. Formula One is just a medium to get to a yeah, larger conversation.
Yeah, I love that. And what about podcasts? Are there any that you're listening to at the moment?
I listen to two simultaneously. So the Map Faber show, which is about investing, which I think it's fascinating, the people he brings on, and they always have nice stories. And I listen to the UK Wine Show because I follow a wine course to get more knowledge into that. I think it's fascinating what they do as well.
Yeah, that sounds really cool. And do you have any role models in either in your professional life or your personal life? Is there anyone that you look up to?
Not really. Not really look up to. I have huge respect for a number of people. So one of them is my first boss, Tom Siemens. He really taught me a lot about how to conduct yourself professionally. He is so knowledgeable on financial markets. I really admire the way how he can uh, explain very complicated things very condensedly to like in layman terms, basically. And in terms of sports, I love what LeBron James does on the Los Angeles Lakers. So I watch basically every Lakers game, see him in 2 years ago in person. So it was very impressive.
Yeah, some good picks there. Tom Simmons, the king of tact and explaining things succinctly, and also finance. Good.
Yes.
Yeah. My last question for you is: has there been a course or class that you've taken that has stuck with you to this day?
Introduction to banking and stock exchanges. Yeah, that was the first course I ever took, and that was like, yeah, this is it. This is amazing. Uh,
What
yeah.
did you learn from it?
So this is basically what is a stock, what is a bond, what is an ETF. So it's not that what I learned, but the person who taught it was very inspiring, was very knowledgeable. So that was really interesting.
Oh,
And in grad school, I was at Stanford and I got empirical asset pricing. So it's more theory, but it was like fascinating, like what you can actually do with models, what you can actually try to understand from the real world just by looking at numbers. I thought that was fascinating.
yeah, you know what? I will say that I find it very fascinating as someone who never really was into finance, and I was more on like the creative side. I was like always sketching things and like very artistic, but like as someone who doesn't like get that fast or like never really in my life got fascinated by finance things. It is very fascinating to me to observe people who are passionate about finance being like, oh my gosh, the first time I learned about ETFs and bonds and like, whoa, that blew my mind. I'm loving it for you guys. Yeah, but thank you very much for sharing all of that with us. It's been a pleasure to get to know you a little bit better. Now, I think it would be a great time to move on to our topic for today, which is understanding the core of modern investing. Before we get to that, I would love for you to define some key terms. So, for starters, how would you define affluence?
Well, for me, it's the fact that no matter how much more money you have, it doesn't really change behavior. So it doesn't change who you are or what you do. So let's say you're okay flying economy. Well, if you have a million, additional million, you're still going to fly economy. Or you like to do this and this and that. Well, it doesn't really change your behavior. Well, that to me is what I would define as being rich.
Yeah, like would you say that like in terms of well, if you like real like richness or affluence is like not letting money change the way
Yes,
you like to do things? Yeah.
exactly.
Yeah, for sure. And on the other hand, when it comes to stocks, what is the definition of it? What would we be referring to when we talk about modern investing?
But that's a very difficult question to address because nowadays, with a lot of technology, the barrier to invest becomes significantly lower. So, to give you an idea, something that's very popular in Belgium, in the UK, and will become very popular on this side of the world as well, is investing with pocket change. So, what do I mean by that? Let's say you go and buy a coffee. Your coffee is $4.99. Well, that the bank is going to charge you $5. That 1 cent is going to go in a separate account. Once you have like $5, $10, that is going to be invested in the stock market. So that's investing with pocket change. So that's why like affluence in the stock market with that invention, but also with something which we call fractional investing. So you're not going to buy one share, but 1/10, 1/100th of a share. Then that makes it so much more accessible for everybody to invest that affluence and or being able to participate in a stock market becomes significantly lower.
Yeah, and that's kind of what we see with crypto as well. Is like you kind of on most platforms you put in the amount of money you actually want to invest, and then it like cuts it down to fractions, right? Yeah, so that's really interesting. I am keenly awaiting this, seeing banks roll this out potentially on this side of the world. My next question is, how would you describe the relationship between stocks and affluence?
It's definitely a very important aspect of it because so what I do when I teach investment decision making at our university, one of the first questions I ask is, okay, what are your expectations? What do you think the S&P 500, so the 500 most important US stocks, that index, what do you think on average that does over 1 year? And so I get a lot of answers, and the answer is, well, it's on average around 8%. Now, if you know that central banks try to get inflation around 2, that means your real wealth, so your purchasing power, increases on average with 6% per year. So that's why, sure, there's a lot of risk associated with that, and we can get more into that later. But letting your money grow 6 real or 9, 8 nominal percent per year, that actually leads to a lot of wealth creation over a longer term. And that is significantly more when you look to other asset classes. Think about bonds. I have a book that talks about wine, that talks about whiskey, art, handbags, and everything like that. But even if you compare to that, stocks is one of the better performing asset classes we have. Sure, there's risk, but also there's return. And that return you can use to become like more financially independent or more affluent.
Yeah, and I'd love to get further into detail about like investing in index funds, particularly with the S&P 500, because it's like the known, when in doubt, go to S&P 500, right? But before doing that, because I feel like there still needs to be an understanding of like a general understanding of what you're doing here. It's unwise to really like just take someone's word for it and then like invest because they said so, and then later you're gonna be like up in arms and like regretful about it, being like, maybe I should have understood like what I was doing. But at the same time, investing does feel overwhelming to a lot of people, especially if you're not like in the finance realm whatsoever, like me, for example. So in simple terms, what exactly does it mean to invest in stocks?
So if you invest in stock, basically you buy a piece of a company. So a company has X amount of capital. Well, you give or you get a percentage of that capital in return for your money. So if that company grows, since you have a percentage of the company, that percentage also grows in value. So that for instance is what stock investing is. If you think about the other extreme, it's not really extreme, but it's bonds. Bonds is a loan. So you give money to a company and you get that money back with a specific interest rate. The difference with a stock is you own the company. So there's no guarantee that you will get your money back. But if the company grows, you will grow too.
Yeah, and what should people understand about stocks before investing, especially when it comes to index funds? There's a general understanding with like the S&P 500, for example. These are the top 500 companies in
Mhm.
what was it, the USA or the
US,
world?
yep.
The USA. Yeah, and so there is like some amount of trust there, right? That like it has to go up. But what do you think people should know before they go ahead and just do that?
Well, if you take one step back, so
Yeah.
if we again start from the concept of what is a stock. What is a stock is you buy a percentage, a portion of a company. So what do? You hope that that company goes up in value. But you are exposed to a lot of risk associated with that specific company. So if you take my example, I live in New Zealand. One of the companies that is listed is the Auckland International Airport. Okay, I invest in the airport, so I hope that the airport actually attracts a lot of passengers. Okay, that's fine. Now, COVID happens. Bam, travel is restricted. So now I'm left with something that will not generate any revenue whatsoever. Why? Because no planes whatsoever fly in the airport. So that's what you have. I have something and I'm very much exposed to the risk of that specific company. Okay, that's one thing. The second thing is, let's say I'm an investor and World War III breaks out. Like in the Middle East, things are not going very well. World War III breaks out. Everybody wants to get rid of every single risky asset. So sure, I'm exposed to my risk of the airport, but like the airport is not going to be involved in the war, but everybody wants to get rid of risky things. Everybody wants safety. So what is going to happen? The market is going to crash. So why do I say this is because I'm also exposed to not only firm-specific risk, but also market risk. And that is what individual stock investing is. So that is individual. And so you ask me the question, what is an index fund? Well, an index fund is nothing more as a combination of individual companies. So you mentioned the S&P 500. Those are 500 individual companies. So what will happen is I'm not only exposed to the airport, but I'm also going to add other companies next to it. Because maybe the airport goes up in value, something else goes down in value, and so on and so forth. And what I'm eventually going to look at is, okay, if I take that entire collection, those firm-specific risks are going to cancel out, or to some extent, to a very large extent. And the only thing I'm exposed to is that market risk. So the market in the stock market in general is risky, but you also get a very high return for that. So that is from starting from individual companies to then index funds. So you're still exposed to this market component, but those individual risks of those companies go away.
Yeah, that's a really interesting perspective. And for those who are new to investing, what would you say are the core principles that they need to understand about modern investing before buying their first stock?
So what we always teach is that diversification is very important. And diversification is important for two reasons. So diversification means I'm not going to put all of my eggs in one basket, but I'm just going to spread it over a couple of baskets. So again, I'm not going to invest everything in one stock, but I'm going to choose multiple stocks. Why? Because risk decreases. And that, I mean, again, firm-specific risk. But also, the second thing is, if you diversify, you also increase the likelihood that you have these huge outliers. And what do I mean by that? If you go to the US in the last century, so the last 100 years, 10% of the total wealth creation in the US comes from 5 companies: Microsoft, Amazon, Google, IBM, and GE. Those 5 companies generated 10% of the total wealth creation. So if you diversify, you increase the likelihood that you have one of those 5 stocks in your portfolio. Because I'm very confident in saying, hey, last century, these were the 5 you had to have. If I'm going to ask you, hey, which 5 companies are going to outperform the next century, your guess is as good as mine. Or maybe mine is a little bit better, but also I'm not 100% sure. So that's why diversification is very important, because then for sure I have one of those stocks in my portfolio.
Yeah, that makes a lot of sense. And I think so. I don't personally invest in anything. Actually, I do, but like not that much. And my partner is like a lot more on top of like investing in stocks and stuff like that. And what he does is kind of like he keeps up with the news and he kind of just like analyzes the trends at the moment, where the market is going, kind of like does like smart calculations about like where a brand or a company is going to end up based on like the news that's come out. What is your advice for that approach?
So I personally have nothing against that approach. So that is what we call active investing. And active investing means I'm going to do my research and I'm going to pick those stocks which I believe are going to outperform. There's nothing wrong with that approach. If you ask me as an academic, so I'm going to put my academic hat on average, we know that doesn't work. On average per year, around 30% of funds, so institutional investors, are able to outperform the market. That means that 70% are not able to. But that's 1 year. If I'm going to ask you, hey, of those 30, who's able to outperform 2 years in a row, that number drops significantly. There will be some, so I'm not saying it's impossible, but it's very hard to consistently outperform the market. So that's why, especially if you're just starting in this entire journey, ETFs, exchange traded funds, or those index funds as you were referring to, are a very easy way how to actually get into the market. Why? Because you don't need to do research. You don't need to know anything about specific companies. So, for instance, I own an ETF. I know what the 5 top holdings are. I don't even look at the rest because I generally don't care. I just know this is the exposure I have, and I have exposure across the world. And that's about it. So I can do the analysis on which stock is going to outperform. I just choose not to. Why?
Yeah.
Because then I have to spend so much time keeping up with the news on that specific company, read what other analysts are saying, and that takes a lot of time. So
It does.
if you
Yeah.
don't want to invest the time, well, there's this passive way, just buy the ETF.
Yeah, it does take a lot of time, I will say that, like just for transparency, because I know there are probably going to be some people who listen to this and go like, oh, that sounds like a little bit fun. Like I want to keep up with the news and like make, do like that's going to make me feel fulfilled. And I think there is a certain genre of person that would definitely enjoy that. But like I will say that like my partner on average, like every single night he reads Reddit and he reads the new he stays on top of the news so much, so like only because he's not that, I guess, he's not that committed to his full-time job. So like if you have a job like that, potentially that's something for you. But if you're already like overworked and stressed about your job as it is, like it might not be the right route. But also like the other benefit of ETFs or index funds is you get that diversification or like just like that, right?
Yeah. So again, if this sounds very appealing to you, please go for it. I'm not discouraging it. The only thing I'm saying is, in my previous job before a PhD, I managed 18 billion euros, and it was my day-to-day job to beat you. So fine, like I'm not perfect. Nobody is. There will be people who will beat the market, and that's amazing and good on you. But on average, we know it doesn't work. So that's the thing. Like there, as I mentioned, 30% of people outperform. Somebody has to be that 30%. I hope it's one of your listeners. I wish them the best. But it also means that 7 out of 10 people don't do it. So the odds are a bit stacked against you. So if you want to do it, go for it. But it takes a lot of time, especially if it's not your day-to-day job.
Yeah. And what are some other common mistakes that you have seen beginners make when they first start investing in stocks?
So overconfident in their own ability and overtrade. So trading costs do stack up significantly over time. So the one piece of advice I also give students, if you again look at the outlook of financial markets, is time is in your favor. So investing is something that is 5 to 10 years in the future. So do it with money you can miss for a significantly long period of time. Because things will happen. We had, if you go to a European situation, we had 2008. Then a couple of years later, we had 2012. That is a sovereign debt crisis in Europe. Problems in Greece, in Spain, whatsoever. Not so much later, you had COVID. and so on and so forth. Then you had the invasion of Russia and Ukraine, and then now you have the entire situation in the Middle East. There are so many moments where the market drops, and if you are forced to sell in that specific moment because you need money, you're in bad luck. So that's why time is in your favor. So don't try to time the market, just ride it out. Just take your time. Don't be patient. Don't try to become a millionaire overnight. That's never going to work and never going to work consistently. Just do compounding year after year after year, and you will become affluence.
For sure. Like, don't, like, if you have X amount of money that isn't quite your spending money, don't just put all of the X amount of money into stocks, right? Because yeah, at some point, rainy day, you're going to need some cash. So you should have that ready to go. And if you pull out at an unfortunate timing, you could be losing out on quite a bit of money there. And of course, like, not to take like too clinical of an approach to unfortunate circumstances, but it's kind of about like making sure that you are setting yourself up for financial success, and that's what the show is all about. And speaking of market yeah, and speaking of market drops and volatility, they tend to be really anxiety inducing, especially when you're new to it and you haven't done this before and you're facing the market drop or like volatile action for the first time. So, what is your advice for managing stocks through these dramatic changes in the market, whether or not you have some money in an index fund or an ETF or just in like individual stocks?
So, if you want to lower the volatility of your portfolio, stop looking at it. If you look at it a couple of times a day, you will get stressed, you will get anxiety. Stick to a plan, trust the process, and just wait it out. Look at it once a month. It's very hard, but try to look at it once a month. Get an update of where things are going. That's the one thing. The second thing, which we have seen work very nicely, is don't invest a lump sum. Invest every single month, because then you will buy upwards and downwards at the same time. So that's something I do. I get my wage every 2 weeks. One portion goes into an ETF. So I buy when the market is up, I buy when the market is down. The average is going to be okay. Yeah, if I have perfect hindsight, I will only buy when the market is down. But I don't know that. I have an idea, but I don't know it for sure. So that's why I buy up and buy down.
Yeah, that's really interesting to me because as someone who was never really dabbled in finances or stocks that much, I always had the idea like as as an opportunist, right? That like I should buy when it's down, buy when it's down. So what is the benefit of buying even when it's up?
Because if you go and look at the last 10 years, what seemed very high 10 years ago is significantly lower than we are nowadays. So
Yes, you
that's
make a great point. Yeah.
so that's why, like, I say on average it's 8% that comes from somewhere. So I have data that goes back 2 centuries, and there you see like market goes up gradually over time. Sure, that doesn't mean that there's never going to be a down year. For sure, there is, but on average, it's 8%. So that's very nice.
Yeah, you gotta play the long game.
Exactly. Yes.
Yeah. And my other question for you was with modern technology, which I think this is something that you mentioned a little bit before, not specifically about modern technology, but um, in particular, I wanted to touch on how there's so many ways to invest in stocks now, right? Whether it's an online brokering, is it brokering or broking? Brokering
Broker, brokerage. Yeah.
brokerage service, or like a full service broker, or like a banking app or a neo banking app, even we have those now, or an investing app, etc. What are the differences between all of these? What are the considerations that people should take into account when they decide, which route they want to go to with investing in stocks?
So there are many different many different platforms rise up every single year. So the one thing I would say to your listeners or the people who are watching is costs are very important. Costs add up over time. Now, if there are firms that offer something which is free, nothing is for free. So costs are associated somewhere. So in Europe, for instance, you have a firm which offers free trading, but it lends your assets out to other funds. So if you have a very huge crash, there is a possibility that you can't get your assets back. So that's the flip side of that thing being free. So that's why, like, you really need to take a bit into account, like, who are you actually buying stocks from? So who is your broker? And costs are important, but free is also never free. So that's why, like, try to look for something with a nice reputation, with a track record that has been around for some time, and maybe that's supported by a bigger financial institution, maybe a bank, for instance, because then it doesn't solely rely on their broker performance. They're diversified within a larger company. So in that sense, like, that is a very good, I think, piece of advice. Like, look a bit on the firm you're actually going to business with.
Yeah, that's definitely really good advice, especially for someone like me who like sees free and goes like, "What a deal!" So, what are some other things that, or like claims, I suppose that people should avoid or like be a little bit more aware of when they want to select a service or an app?
So I think reputation comes from that track record as I was referring to, because it's very hard to consistently be a service provider in the financial industry. So there are some apps nowadays. Think of Robinhood in the US, for instance, that break through, but those are very rare. And that is for a reason, because you need that trust, you need capital to actually build up a business. So I, for instance, just invest with my bank in New Zealand. I don't try to do these fancy things because I just trust the service that they provide, because they've been around. As I mentioned, they're part of a larger institution who does banking, who does insurance, and just broker. Their broking business is just one small part of it. So in that sense, like, I don't try to be fancy, because if I want to do something, and where all of these financial services, for instance, differ is, sure, if you want to invest in Australia, that's fine. But once you want to do something outside, something, let's say, hey, I want to invest in the S&P 500 in the US, that's where these huge differences actually come in. That's where transaction costs can become large. That's the one thing. The second thing is, if you invest with those companies, do you have to pay specific fees every year for them to actually hold your assets? Because those small fees also actually add up significantly over time. And that's not only for those services, but also that's the difference, for instance, between an ETF, which is just following an index, and that Vanguard and State Street or BlackRock, for instance, they have ETFs where you pay 20 basis points, so 0.2%. But you can also go to mutual funds where you actually have an asset manager who manages your assets, so manages your money, but they charge 1.5, 2%. So that means that instead of that 8%, they already have to have 10% in order for you to just break even. So also there, those may not seem very small, like, what is 1.5%? On $100, well, it's $1.5, so it's not a lot, but it adds up. So that is also something you really need to look out for.
Yeah. And on the topic of modern investing, um, there are lots of new technologies emerging at the moment. We talked a little bit about crypto. Now AI is becoming increasingly prevalent, exponentially so, blockchain, what have you. So, how do you see all of these new technologies changing the landscape of stock investing?
So let's do one at a time. So let's start with AI. I don't believe that AI will be a huge game changer in the world of investing. AI is very important and will change the landscape of labor markets. I use AI for my work. I use AI within the classroom. That is super important. But in the world of investing, not at all. And why do I say this? Well, exactly 10 years ago, I was at Stanford and I followed a course, quantitative trading or algorithmic trading. So everything we know nowadays about AI was already doing 10 years ago. And if I was doing just as a simple student, a lot of asset managers were doing that already too. So let's say that I'm wrong, and let's say everybody tomorrow starts using AI to select which stocks they're going to do. Well, everybody is going to use the same data to actually train their models because you only have so much data. Like, I think the longest data set you can have is 4 centuries, which for an AI model is very limited. So, okay, let's say I'm wrong, everybody's going to do that. Well, then your boyfriend, who does his own research, actually is at a huge advantage because now all of these AI models are competing against one another. Well, now the cost of doing some research, well, is super low because they're competing. Well, he actually looks at what all these companies are doing, and then he can actually get this human component back into the equation. Well, now he's able to outperform. So there will be a swing between, like, there will be some AI usage, but if you have more AI usage, the cost of doing your own research, human research, will go down and the performance of those researchers will go up. So that's why you will have this pendulum that will swing one way or the other. But to me, that pendulum is not so much different as the internet, for instance. So in that sense, like, it's the same kind of impulse and the same kind of technologies those firms have been using. If I can give one more example, there's something which is called high frequency trading. Maybe you've heard of it, but for those of you who haven't, that is trading at microseconds. Literally a blink of an eye, you do 1 million trades. Those things also have been around for like 10, 20 years. That is not something that will improve massively with AI. These things are already here. So that's why I think AI, while very important, is not going to dramatically change how we are going to do things. It's going to make some stuff more important, others not so much. If I can add one more point on that. So I did a study and I gave people an estimate. I said, hey, Goldman Sachs says that the S&P 500 is going to do 5% over the next year. Are you going to invest, yes or no? I gave another group, hey, Goldman Sachs using an AI model says the S&P is going to do 5%. And then the third group, hey, an AI model says the S&P is going to do 5%. Who do you think was more likely to invest? The humans,
The first one, yeah.
not AI. So even though AI can already do this job, this trust component in AI and AI advice is not there whatsoever. And we call this algorithmic aversion. We still don't really trust machines to that extent. So that's what AI is. Crypto is another story. I'm not a huge believer in crypto as an investment. As a currency, it's amazing. As an investment, it's a different story. And that's where we come back to what I said earlier, like Bitcoin, for instance, amazing return. If you take volatility into account, still nice, but not as impressive anymore. So it goes up, but it also goes down significantly. Blockchain, on the other hand, that has a lot of potential, but it has potential for the last several years. And we see it only very slowly getting into actual applications. So I used to be in asset management. I thought a couple of years ago that where we are in asset management industry, that a lot of these back office performance tasks were actually gonna be replaced by blockchain, and we're not there yet whatsoever. So I was more optimistic about blockchain, say 4 years ago, than I am nowadays, even though it's still very impressive.
Yeah, well, thank you for sharing that. That was very illustrative illustrative of an explanation. And I was also curious about, the inflation and recession like piece with global instability at the moment. It's obviously not like an isolated incident. Like things have been really unstable before in the history of the world, right? Like and financial history as well. But what sort of investing trends also forgot to mention this, taking the emerging technologies into account here. What sort of investing trends do you think the average investor should expect over the next 5 to 10 years? Do you reckon, like, even with emerging technologies and how the world's changed so far, that history will more or less be the same pendulum swinging thing, or do you think that there could be something a lot different that people have to be prepared for?
So if you look over the last 2 centuries, one of the key features is that financial crises are still among us, but way less frequent. So it used to be significantly more frequent that you had important financial crises. The 19th century, earlier 20th century, you had the Great Depression. Sure, you had still the financial recession, but it becomes more rare to have big downturns. Not to say that they won't happen, but they're becoming more rare. So that is already something interesting, at least, because especially since 2008, we've seen that central banks have this, what we call unconventional monetary policy. Say, push a lot of money into the market to actually stabilize it. That's the first time we really have seen that on such a large scale across the entire world. So now we have policymakers who are willing to do maybe too much to actually stabilize markets to some extent. Now, what new technologies will we see over the next 5 or 10 years? I think fractional investing becomes significantly more important. So, what do I mean by fractional investing? You're not going to invest one share, but 1/10, 100th of a share. Now, what we also will see, and that is a strand of literature I'm working on, is collectibles. I already mentioned I wrote an entire book on wine, whiskey, art, vintage cars, and so on and so forth. In Europe, you have Burgundy, you have what we call DRC, Domaine de la Romanie Conti. One bottle of that is about, I would say, 50,000 Australian dollars, just for a normal bottle. I'm gonna speak for myself. I can't afford that. Now I can afford 1,000th of that. So I can have exposure to that specific bottle for a price I can afford. So that to me is something that will happen very soon. It already happens in the art market. It happens in stocks. Robinhood is very famous for doing that. But it also will happen to other aspects of our life. And I think these collectibles, there is a market where a lot of funds can still generate a huge return. So, for full disclosure, I'm on the board of 2 wine investment funds. So I also advise funds to do selection for wine because there is not an ETF for wine. And we have very nice returns over the last year. So I think we have on average about 22% after costs and after fees. So that there is a very nice performance. But a lot of, we don't do anything special. A lot of competitors can come in. If they do, that will bring down our return, but also increases competition. And that will actually enhance all of these things I was referring to. So I think that fractional investing is going to become significantly more important in the future.
Yeah, that's really interesting. Thank you so much for sharing your expertise with us. It's been such a pleasure to listen to you talk about this subject. You're clearly very passionate, but I see that you take after your role model, which you said wasn't actually a role model. So spare me there. I'm sorry,
No
but you do.
worries.
You're really succinct with your explanation, so I really appreciate that. I think now would be a great time to talk about the day-to-day application of what you've shared with us. So, what do you think is a habit that would be really useful when it comes to investing in stocks?
So a habit is, if you pick a strategy, stick to your strategy. Because the one thing we do see quite often is something which we call loss aversion. So people do not like a 1% gain as much as they hate a 1% loss. So it's something you were referring to earlier. If you see a lot of volatility, if you see your portfolio going down, people want to sell because, no, again, stick to your strategy, believe in your strategy. That's the one thing. On the other hand, I like to say, don't regret the money you made. If you sell today for a specific reason and the market goes up tomorrow, don't regret. Why? You didn't know. Nobody knows what tomorrow is going to bring. So never regret the money you made. The best investor has the investment of tomorrow for making decisions today. So that's never going to happen. So that's why you have this loss aversion on the one hand, and don't try to regret too much. Pick a strategy, just stick to that strategy. So for me, that is invest every 2 weeks a small portion. I don't even look at it, it goes automatically. I don't want to deal with that whatsoever.
Yeah, and have you in your in your professional life, have you ever like struggled with that anxiety before? What advice do you have for people when it comes to like just wrestling with that emotion? Because like sometimes even the best investors, like they might like feel emotionally about it, they might not act on it, but they might feel a certain way on the inside. So what's your advice for managing that anxiety and that loss aversion kind of emotion?
So I'll tell two quick stories, so personal stories about myself. So as I mentioned, I had to make a choice in 2008 what to actually study. I chose finance, and that was also the time I invested my first stock. And the stock was KBC and at that time Fortis, two Belgian banks. One stock I purchased at 50 cents. Year later, it was about 80 euros. So it was a huge drop. Yeah. And KBC at the time was about 5 euros. So I bought them because I thought there's no way in hell that our government will let those two banks go bankrupt. Eventually, I was proven correctly, but I didn't have the guts to wait such a long time. So I bought them, they went up, I made an okay return, but I had so much stress that I was like, I can't deal with this. It gives me too much headache, so I just sold everything. That was also the last time I held individual stocks. So that's when I knew this is not for me because it caused me so much headache, it caused me so much stress. I don't want to deal with this anymore. Then a couple of years later, so even after my PhD, I was in a bit of a similar situation. I was looking at my portfolios way too often and I was too stressed out. I had a nice performance of my ETF, and I was just like, I'm just dealing with this way too much, way too emotionally. I'm just going to sell and I'm not going to look what it eventually happens. So if I would have stayed, like my performance would have been even greater, but like I don't want to deal with this anymore. So I just sold. So that's I think my biggest advice is like, if you can't handle the heat, stay out of the kitchen. So in investment terms, if you can't handle the stress, don't do investing, and especially don't do active investing. Now I have a separate account. I don't look at it. I don't even have the app on my phone. It just goes automatic. I'm very happy. I don't look at it whatsoever. I have stress enough in the wine business. I don't want to deal with that stress in the equity sphere.
Yeah, watch pot never boils. Yeah.
Exactly.
Yeah. Well, thank you so much for sharing all of that with us. It's been very insightful to hear from you. I think now will be a great time to go into the open mic segment. And this is where you'll get a chance to talk about anything that you're passionate about at all. And it doesn't have to be related to the topic. But if you'd like it to be, you can most certainly make it about investing in stocks. We won't stop you. So take it away, Gertjan.
No, so what I'm currently doing and what I'm super passionate about is wine. I already mentioned it a couple of times, but I have spent a lot of years collecting the biggest data set in the world when it comes to wine auction prices. So I've more than 6 million transactions now on every bottle of wine basically traded all across the world. And I think that is for your listeners a very good insight in what people are actually doing to try to get an edge of understanding, but also in terms of performance. I am willing to go beyond just to have an insight in, okay, how does this market actually work? So what I'm doing with that, I'm doing a number of things. So first, I'm trying to understand, hey, why do wine prices move over time? Because my thing is, a wine is actually pretty similar to a bond. Why? Because wine has a maturity, wine has a rating. It's traded on secondary markets, meaning like on an exchange. For wine, it's an auction. Um, and if you, for instance, want to buy and drink wine, well, you have people who buy a bond and hold it to maturity. So you have similar type of investors. One chateau, one winery produces a specific wine, and there's no more of that wine that will ever be produced in the world. Same for a bond. Once you issue it, there's no more of that specific bond. A company has multiple bonds, a winery has multiple wines. I know there are huge differences, but the way how we, and especially I, look at this is there are a lot of similarities. So what if we do everything we do in the bond sphere and we apply it to wine? And there what we find, for instance, is that the lower priced wines actually have a lot of value. So don't look at your $1,000 bottle of wine. That is not where most of the gains are. Most of the gains are in those bottles about 100 euros, $100. That is where money can be made on the one hand, but if you're a consumer, that is also where value actually is. So if you want to buy something very nice, it's still $100 is still a lot of money. I am well aware of that, but you'll get a lot of value for your money. That's the one thing. The second thing we also find is that rating plays a huge role. The higher rated wines also perform very nicely. So that's something I'm doing. What I'm also am doing is trying to see how climate change actually affects wine prices. So what I'm doing is I look at wine from Bordeaux, from France, but that's traded all across the world. So that's traded in Australia at Langton's, that's trading in New Zealand at Webb's, in China at Chinese Guardian, and so on and so forth. So I look at the same bottle across the world in the same month, and I try to understand, why does that price move? Because basically that should stay flat, because if you're willing to spend in one specific country, it should reflect prices in another country. Well, that's not the case at all. That moves significantly over time. And I try to understand, okay, why is that? What can we understand about human behavior through these wine prices? So that's something I'm currently doing, and I'm going to spend most of next year on as well.
That is so interesting. Can I ask, just as someone who
Sure.
is a casual fan of like data sets, data analysis, and visualization, and all that kind of stuff, how did you obtain that huge of a data set about wines?
Web scraping, human collection, merging.
The whole 9 yards.
Exactly. So I
Yeah.
spent with 20 people so far. And I, as more the project manager, getting all of that, knowing where it is. I've bought books. I went to archives. I really went beyond to get my hands on what I
That
have
sounds
now.
like a massive project. So I wish you all the best with that. It sounds really fun, but so much to go through, so much information there.
Sure.
Thank you once again for joining us. Now, if our listeners want to find out more about you and what you do, maybe even keep up with some of your work in wine, where can they go?
So I have a website where all of my academic work is, where I post news articles or opinion pieces, where more information about my book is. And the website is www.verdickt.eu.
Amazing. We'll leave those in the show note. Thank you everyone for tuning in, and we'll catch you in the next episode.
Thank you for having me.
You've been listening to Wealth Pathways, the Affluence Science Insights Podcast produced by LMSL, the Life Management Science Labs. More episodes are available from 10 life management perspectives and can be found by searching LMSL on Apple Podcasts, Google Podcasts, Spotify, YouTube, and other podcasting apps available on your devices. If you enjoyed this episode, please rate, share, and subscribe to our channel so that other people can find it and we can continue to provide quality content. More of our work can be found on our website at affluence.lifemanagementsciencelabs.com, where you can join our movement. I'm Marie Stella. Thanks for tuning in.